Welcome to the Andrew Holland Podcast, where we talk about business, entrepreneurship, and everything in between. Now, here's your host, Andrew Holland.
Hello, everyone, and welcome to the Andrew Holland Podcast, where we talk about business, entrepreneurship, and everything in between. I'm your host, Andrew Holland. As a business owner and entrepreneur who have started and sold multiple companies, as well as being a CPA that's worked in the corporate world, I started this podcast to be the ultimate support group for entrepreneurs and for business owners. Whether you're just starting your journey as an entrepreneur or you're thinking about starting your journey as an entrepreneur leaving the corporate world, or you've owned and run your business for many years, navigating the challenging waters that come with that, this podcast is intended to be your weekly go to source for inspiration, guidance, and valuable insights. Together, whether through interviews or some of my monologues or other formats that we come up with, we like to have fun and be creative, but also make sure that we're always learning something. We explore stories of successful entrepreneurs, we dive deep into different practical business strategies, and we discuss everything in between. We do that to try to learn, understand, and be successful in the world of business together. And one of my primary motivations for starting this was because, as you may have felt if you've owned a business before, is at points in time you often feel very alone. And the reality is, with this podcast and with the support group of other people that are going through being a business owner, none of us are alone. So help me grow this podcast and the support group for all of us by following and liking us on your favorite podcast outlet. Subscribe to our YouTube channel, The Andrew Holland Podcast, and you'll get the weekly updates every Wednesday when we post the video version of the podcast. Lastly, follow me on Twitter and Threads. My handle is A Holland Podcast. That's A Holland Podcast. We have conversations about all sorts of things in business, entrepreneurship, and of course, everything in between throughout the week, sometimes related to that week's podcast, sometimes not. But it's another way for all of us to connect as we go through the ups and downs of being entrepreneurs. And of course, lastly, be sure and listen and or watch every single week and share this podcast with all your friends, family, and colleagues. Now remember, we often talk about financial and legal concepts on the podcast, but you shouldn't take anything you hear on this podcast or any other one for that matter as the absolute truth. Be sure that you're always getting the appropriate professional advice for your unique situation. Now this week, you may have heard a lot about the Fed meeting that is happening pretty much as we speak. They may be releasing their rate decision here in July of 2023 on whether they're going to raise rates again for putting it at about, they've raised them starting in March 17th of 2022, and they've raised them pretty much every meeting since, going from 0% all the way up to 5%. If they raise them another 25 basis points, they're going to have raised them about 5.25 percentage points in the last 15 or 16 months. And everybody's wondering, what is the impact of these rate decisions? What's happening in the economy? Obviously, inflation has been a huge concern over the last 15 months, which is the very reason that the Federal Reserve is raising rates. And we saw that the stock market in 2022 did not respond very well to those height increases or those rate increases. But in 2023, the story's been very different. If you would have asked most economists in January, February of 2023, a lot of them would have said, we're likely headed for a recession. But now, as consumer sentiment still seems to be relatively strong, consumer spending seems to be stable, the market, the labor force, by all metrics, unemployment rate being one of the primary ones, has remained extremely solid. It's caused a lot of disagreement as to what's going on with our economy. Why aren't we in a recession? We've heard of this idea of a soft landing, and can the Fed navigate that thread through the needle and have raised rates almost by 5.25 percentage points without sending the economy into a recession, which historically has been very rare, if has ever happened. And I myself would have predicted or have thought at the beginning of this year, given the rapid increase in rates, and if my statistics serve me correctly, it's the fastest rate hikes in history, I would have guessed we would have seen more cracks in the economy. And so today, I want to talk about why should we as business owners care? And if you're an executive in an organization, maybe you don't own the business, maybe you do, you're often thinking about the economy and what is it going to do to your business. But why? Why do you care? And then I want to talk about just a few statistics that I don't think are widely discussed. And certainly the Federal Reserve is looking at all of this data, but things that I'm trying to look at to better understand where are we headed. Now, why is it important for us as business owners to care? Well, I think just personally, whether you own a business or not, you like to know whether we're going to go into a recession because it does have a lasting impact on every socioeconomic status, but particularly the middle class. And that's because as rates go up, when we go into recessions, typically you see purchasing power on our behalf as consumers go down. You see business spending on capital investment go down, meaning they're not buying as much equipment, meaning they're not investing into their employees as much. And very likely in recessions, you see layoffs, meaning the unemployment rate increases. And of course, with layoffs, that means families can't afford to pay their mortgages or their auto loans or their credit card debt or support their families. We have not seen that thus far, in spite of the rapid increase in rates. And it's a bit perplexing to me that we haven't seen any major crack. And that's what we'll talk about in the second part of this. But obviously, as business owners, when rates go up, getting loans, investing in your business is more expensive. And the reason the Fed raised rates, as we just said, is to really slow things down so that they can rein in inflation. And they always talk about a 2% target rate. That's where they're trying to get inflation year over year is 2%, because that means that your monetary value is increasing, but not at an alarming rate. Inflation, for those of you who don't know, simply means that prices are increasing rapidly or they're going up, meaning that what your dollar can buy is less and less as inflation gets higher and higher. Probably one of the best, most recent examples of inflation within the last century is what happened to Germany after World War II, when their currency basically became worthless. And to buy a loaf of bread, you had to have a whole wheelbarrow, according to some reports, of their currency. And I don't remember what it was, the German mark or something of that nature. Of course, it's the euro now, but it was worthless. And so the reason the Fed was invented was to prevent the economic cycles of the United States from being so high and so low and monitoring it. Now, some argue whether the Fed has successfully served their purposes over the last 60, 70 years. I don't remember when they were instituted. I think it was after the 1929 crash, but someone can fact check me on that. But when we look at what they've done over the last 15 months, and we look at the impact that it's had on the economy, and small business is really the key economic engine of the American economy, with, I believe, small businesses employing almost 85 to 90% of all people, things don't seem to add up, at least to me. And as I said, I'm a CPA. I was a business economics major from the University of Wisconsin Eau Claire. That doesn't make me an expert by any means, but I want to delve into some of the things that I'm looking at to see if maybe we can draw some parallels from statistics that we've seen in the past. As business owners, when we're thinking about hiring new people, we want to have a level of certainty that we're not going to be going into a recession. We want to know that if we want to invest in our company, it's not going to continue to get more expensive if we're going out there to get that loan and rates keep increasing. We want to better understand, are our profit margins going to remain where they are, meaning that consumers are spending money on what we're providing, whether it's goods or services? So, why haven't we seen, as money has gotten a lot more expensive over the last 15 months, a significant pullback in consumer spending? Why haven't we seen a significant uptick in the unemployment rate? We're still at historically low levels. I don't remember what the last reading was. I think it was 3.6%, which came out a few weeks ago. it's an anomaly, or it seems to be an anomaly from everything we've seen historically speaking when the Fed has raised rates. And again, we just said that they've raised rates at the most rapid pace they've ever done, raising them about 5.25 basis points if they raise them this week over about 15 to 16 months. When I look at some of the crashes that we've had in the past, the most notable being, of course, the Great Financial Crisis in 2008, and what we're seeing today, I don't see a lot of similarities. And the reason being is 2008 was primarily a result of poor lending standards in the housing market. And so you had people that were making $50,000 a year with three different homes, and the home prices just kept going up, and people thought it could never end. And then it did. In today's world, we've certainly seen an increase in prices in the housing market, but we haven't seen the standards for lending on homes gotten too aggressive, meaning not verifying income, just giving out mortgages to anybody and everybody to buy any home. And when you actually look at mortgage default rates, historically speaking, at least in the last 15 to 20 years, they're relatively low, around 2 to 3%. And we'll dive a little bit more deeper into some statistics here. And I don't want to get too wonky on them, but I think it's important to look at data to make informed decisions. So let's dive into that. And the whole basis of this is nobody really knows what's going to happen with the American economy. But when things don't make sense to me as a business owner, when you're trying to make capital investment decisions, when you're trying to think about should I hire more employees because consumer demand for my goods or services are going to stay where they are or grow, or are we going to have a recession and they're going to drop? So I don't want to make that next investment in the additional worker or capital business machinery, or excuse me, uh, machines, equipment, what have you. It's important to think about this and try to at least anticipate, or not be entirely naive about what the possible outcomes are. Nobody really knows what's going to happen. No human really knows what's going to happen. But I think we can make better informed decisions as business owners if we can at least look at the data, look at history, and see, is there anything we can learn from this? And I think if you surveyed economists right now, there'd be a huge split on whether we're going to see a recession or whether we're going to see a soft landing. And I read the Wall Street Journal every day. I try to consume as much information about this as possible because number one, I'm naturally interested in it. Number two, as a business owner, it's important to be abreast and informed of what's going on, both in the financial markets, but in the daily consumer spending habits, all the different statistics, whether it's the labor markets, the real wage growth markets, the PPI, which is the producer price index, which is how much are goods and services getting more expensive for producers, manufacturers, which are kind of the basis of where the pricing chain starts. So let's dive into some data that I'm looking at to try to make sense of, to me, and I'm curious to hear your thoughts, of an economy that doesn't seem to make sense. It doesn't make sense to me that we can raise rates by 5.25 basis points over a 15-month time frame and not have something break, not see some cracks in whether it's consumer spending or the labor market. Or, I mean, we've obviously seen inflation, but it seems to be coming down. The question is real inflation coming down? Or is just core CPI? We're not going to get into the exact basics of how that's calculated, just showing that it's coming down. Is that trend going to continue? So I like to think about it as logically as possible, and you can get to a million different data points and all these other things. But what I think about is, okay, if I'm an average family and I am living my life, have a mortgage, maybe I rent. Rent and housing is one of the largest expenditures for any American individual, family, etc. And I have a car loan, maybe, and I have some credit card debt and possibly some student loan debt. And that's a key piece that we're going to talk about, because with the Supreme Court decision just occurring, where President Biden's student loan forgiveness program being ruled not lawful, everybody or a lot of people that were having their student loans deferred, that's going to end here coming up in the fall in September, October. What impact is that going to have? So I want to look at two things. To me, if you're that average family, you're going to default last if things are getting tough on your mortgage because you don't want to lose your house or stop paying your rent. That's the very last thing you're going to stop paying. So if you've gotten to that point, things are really bad. We don't see that in the economy. We don't see huge defaults on mortgages or renters not paying their rent. So we're not there yet. And then I look at auto loans and I look at credit card debt because credit card debt is unsecured. What that means, for those of you who may be not familiar with it, that means that there's nothing collateralizing the financial institution who has issued that credit card to you, what you're spending on it. So if you go bankrupt and you have a bunch of credit card debt, there's nothing for them to take from you. No, it's not quite that simple, but for all practical purposes, it is. Whereas if you have a home, a mortgage, or you have a car loan, they can repossess the vehicle if you default, and they can put you into foreclosure on the home and repossess your home. With credit cards, it's not like that. So if you have credit card debt and things are tight, that's probably going to be one of the first things that you stop paying. So it's important to look at credit card defaults. It's also important to look at auto defaults because I think if you think about it as the domino effect, with that housing being the very last domino that you're going to let fall as a family because you don't want to be homeless, meaning when I say let fall, not pay, I think right next to that is your auto. You don't want to lose your means of transportation to work, taking your kids to school if they don't take a bus, etc. And so that's pretty far down the list. So if we look at the default rates on autos right now, what are we seeing? Historically speaking, compared to 2008, what are we seeing? And I'm looking at these things just to try to make sense of an economy right now that doesn't make a lot of sense to me. One of the things I will point out, and I I'm my expectations, and expectations are really important as business owners. That's why you do forecasts. And then you look at your forecasts every quarter to determine, okay, this is what I forecast or expected. This is what actually happened. And then you adjust those as necessary. But my expectation was when we saw money get as expensive as we have in such a short period of time, keeping in mind that we've had free money since 2010, incredibly free money for far too long, in my opinion. I would expect, as I've said, to see some more cracks and see some more pressure on the middle class. And I'm trying to determine, is it there and we're just not seeing it yet, given so many of the variables that we've had over the last 3, 4 years with COVID, the United States pumping $11 trillion, tons of money, just printing money into the economy, and then having supply chain issues because of COVID, which causes prices to go up, basic supply and demand. Are there signs that we can look at that maybe would indicate, no, we're actually doing okay in spite of the more expensive money with the rate increases? Or maybe we need to be mindful that it may not show right now, but we're on the precipice of something about to break. What's interesting to me, before we get into some data here and statistics, when I look at 2008, and I was just getting out of college, a very challenging time to be getting into the workforce, especially in the financial field, the auditing CPA field where I was going into. Thankfully, I'd had an internship and my job was secure. In February of 2008, Bear Stearns went bankrupt. They collapsed, and it was not pretty. And people thought, "Yikes! Is this going to be kind of the last domino to fall that causes a huge crash?" Well, it failed, but we didn't see really anything major happen until September. So we went through the spring of that year, we went through the summer of that year, and things seemed to be relatively okay. And then September came around, and then it all came crashing down. When I look at this year, And I'm not saying they're the same at all. 2008 great financial crisis, I think, has basically no similarities to the economy that we're looking at right now. And I've listened to a lot of people talk about how where we're now, even Fed Chairman Powell has said over the last 12 months, we're dealing with so many variables we've never seen in the past that this really is an anomaly. So you can draw from historical experiences to a certain extent, but we've got a whole host of factors like I just talked about: the pandemic, supply chain, $11 trillion of money coming into the economy, etc., that we've not seen all operating at the same time. So it's hard to predict where this could go, and that makes the Fed's job pretty challenging. And thus far, at least based on what we're seeing in the economy, that concept of them being able to land our plane, the plane being a metaphor for the American economy, have a soft landing, not too bumpy, not gyrating too much, meaning putting us into a recession or hurting the average middle class individual too much. That it seemed to be working thus far, and I say that very cautiously. But when I look at what's happened, if you think about this year in March, February, March, we saw a couple banks fail. We saw Silicon Valley Bank be the first one, and then we saw Republic Bank out of New York be the second one. And the Federal Reserve and the Treasury Department and the appropriate federal agencies jumped in to save them. I think they would argue we've learned to move very quickly, very swiftly since 2008, where we didn't quite move as quickly to prevent a catastrophic uh, something catastrophic like that from rippling throughout the economy, a bank run essentially. So that thus far seem to have been one-off events. But I wonder, is this similar to 2008? Not the circumstances or variables. I've just said it's quite different. But are we just taking a little break here? We saw the first few cracks, and then once we get out of the summer, when people haven't been able to travel because of COVID, they haven't been able to take that vacation or spend the money or buy what they wanted to buy. I mean, they were able to buy things for their home because we had so much stimulus coming to the economy, but take the vacation and travel. Once that summer high, as I like to call it, wears off and we get into the fall, people go back to school, are we likely to see potentially what we saw in 2008 and seeing some more ripples throughout the economy? I don't know the answer to that, but I want to look at data to figure out, are there any answers? Are there any clues? So, the first thing that I want to look at is debt. Leverage, whether on an individual basis, whether on a company basis, whether on a national basis. Leverage, meaning debt, is one of the primary things that can cause an individual or a company or a nation to go bankrupt. And I should say, being over leveraged, having too much debt in comparison to the money that you have coming in. And so I think it's important for us to look at, and I'm looking on an individual basis here in the American economy, the data. And I'm going for individuals, not companies, primarily because the middle class and the consumers are the backbone of the American economy. And if they are too heavily leveraged and they can't make their obligations, it's going to have a big impact on consumer spending. Now, let me remind you, we don't see that has happened in the headline statistics of consumer spending, but I want to delve a little bit deeper. So I'm looking at total debt balances by age. And all of the data that we're going to be talking about here comes from either FRED, the Federal Reserve Economic Data Base, essentially, or one of the Federal Reserve banks. The New York Fed has a consumer credit panel that releases a lot of the statistics we're going to talk about, focusing on consumer debt at the household level, be it credit card debt, how late are credit cards over 30 days, past 90 days, all data to look at to try to determine, are we seeing an uptick in defaults and things that would indicate we may be having more trouble to come. So, with debt being such a key factor, I looked at, and I can share this in the links or I will put this on the screen, total debt by balance by age. Now, I didn't do it by age in any particular order. I've got it right here. I'm going to put it on the screen as I talk through it. But I wanted to just have a better understanding of where have our total debt levels been over the last 20 years. And when I look at this chart, while we're not seeing any particular challenges in the unemployment rate or in consumer spending, sentiment is maybe a little bit down. We see inflation coming down. One of the things that's so important to look at, I believe, is total debt. And if you look at this graph and you look at what total debt, the last reporting quarter, this is by quarter since 2023. I've got the chart and then I've got the underlying data. Again, this is released by the New York Fed Consumer Credit Panel. Our debt on a national basis by individual, by household, is higher than it has ever been in the last 20 years. And quite frankly, higher than it has ever been historically speaking. Now, why is that a concern of mine? Because if you have that much debt and something breaks, and I don't know what that's going to be. In 2008 was the housing market and tons of people got laid off. If you have that much debt and something like that happens, you can't afford to pay it anymore. And so over leverage can be a really, really dangerous thing when bad things take place, when something breaks. And so I just am weary when I look at our total debt as of Q1 of 2023 being at its highest level ever of $17.04 trillion. $17.04 trillion. And this graph that I'm putting on the screen shows it all. And what's even more concerning is if you look at the two age groups, 30 to 39 and 40 to 49, the amount of debt that people between the ages of 30 and 50 are taking on is growing, even when you look in comparison to 2008. And again, we're looking at total debt. So I'm not breaking it down by mortgages, credit cards, auto loans, home equity lines of credit, and other debt, student loans. I'm just looking at total debt. So it combines all of those things. And again, I don't have all the answers, and nobody has all the answers. But things I'm trying to look for are any signs that if something does break, are we in a position where we can sustainably move forward? Or if something breaks, are we going to see that have a trickle impact throughout the economy? And too much debt means that whether it's homes, that's primarily it was in 2008, but you can have an auto crisis. If you have too much debt in autos and everybody stops paying their auto loans, what happens? Spending on auto completely decreases. You see a bunch of car companies go bankrupt. We saw that in 2008. I mean, the housing market caused dominoes that it was just throughout the entire economy. So that is the really key one. And we're not seeing any real signs of concern there. So that's a positive thing. We're not seeing default rates or debt on mortgages, at least the defaults, be crazy. And historically speaking, there's a chart that I was looking at. I'm not going to include it here where it broke down debt by type. While we're seeing a little bit of increase on the amount of overall debt that mortgages are taking up, it's not, historically speaking, a larger percentage than it ever has been, especially in the context of where we are compared to 2008. There it was cataclysmically high, and we saw what the result of that was. But total leverage is really high. Now, there's a couple of things to point out. Of course, we would expect total debt to be higher if CPI, inflation, is a lot higher, because that means that the dollar goes less far. And so the average price of a new loan, of a new home, all of those things are more expensive. Now, hopefully, if that's the case, wages, real wages, are going up. And what I mean by real wages is that that indicates purchasing power of the consumer. So nominal would be wages including inflation. Real wages are basically what you make. Let's say you make $100 and the next year you make $110. Well, that's a great increase, right? That's a 10% increase. Well, you may have a nominal 10% increase, but if the cost of living, inflation goes up 20%, you had a real wage loss of 10%. So you may have gotten a raise, but everything else around you, cars, homes, food, etc., gas, energy, got 20% more expensive. You're worse off. Your purchasing power went down. So when I say real wages, that's taking into account the cost of living, so inflation. And so I wanted to do a little comparison and say, okay, so we know that our debt is higher than it ever has been, total debt balance by age. But is that a big deal? If debt's a lot higher, that's not a problem if our income has increased by as much as debt has, meaning that income and our ability to service that debt has kept up just fine with the new debt that we're taking on. And so I picked a couple quarters looking at total debt and real wage growth. And again, this is all according to the Federal Reserve economic data or one of the Reserve Bank's panels. And if you look at Q2 of 2012, I just picked something about 10 years ago, 10, 11 years ago. The average median weekly earnings for full-time employees 16 and up, that's the metric I'm using for wages. So that means if you are 16 or older and you have a full-time job, whether it's hourly or salary, on average, you are bringing home $337 every week. Now, this is a median. So if you're looking at the law of averages, mean can be skewed one way or the other. Median is less prone to that. So it's median of $337. Now, I know we're getting a little wonky, but we're going to get to a point, and this is important for us as business owners to be thinking about these things, to make better forecasts, and to hopefully anticipate something that could have a big impact, regardless of the industry in, on the decision making that you have today and how your business may operate moving forward. So Q2 2012, $337. Q1, quarter one of 2023, the average real, so adjusted for inflation, weekly earnings of those 16 or older was $363. So we went from 337 to $363. That's an 8% increase. Okay. Now, where is that in comparison to the additional debt that we've taken on? And that's where I really wanted to figure out, okay, if we compare those same quarters about 10 years ago, what has debt done? The problem is looking at the data, if you look at total debt for those same quarters, so Q2 of 2012, total debt was 11.37 trillion. Okay. Now, given inflation and everything, I expect Q1 of 2023 total debt to go up. There's no question about it. Wages went up, inflation's been high, we've had free money for the last 13 years. I expect debt to go up. Expectations are important. But if I look at Q1 of 2023, total debt did go up. It went up to $17.04 trillion. So that's 11.37 trillion to 17.04 trillion. Real wages went up 8%. Total debt went up by 50%. That's concerning to me because it means that, sure, people are making more money, even adjusted for inflation, but we're taking on far more debt. Our debt levels have gone up dramatically by 50% since Q2 of 2012, and our wages to service that debt, our ability, our income to service that debt has only gone up by 8%. Okay, why are we talking about all this? Why is this important to us? I know we're getting into the numbers, and this is really the first podcast where we've kind of gotten as wonky as we are. But it's important as business owners for us to always be looking at the economy and thinking about, okay, this is a particularly odd time. You got 50% of people saying, I think we're not going to go into recession. There's going to be a pretty soft landing. 50% of people saying, oh, we're going to have a recession. And of course, nobody knows the timing. And anybody that tries to time the market are often proven to be fools, because timing the market is just a fool's errand. But when I just look at some of these basics and thinking about the average family, when I think about my family, when I think about people around me, the middle class, the people that make this economy what it is, and I see something like that where real wages have only gone up 8% over the last 10, 11 years, but total debt has gone up 50%, I get really, really concerned. And to me, again, don't know the timing, but I'm thinking, so we've raised rates by almost 5.25 percentage points, making money a lot more expensive, making home buying a lot more expensive. 13 months ago, the house you could buy now, because rates have gone up, the house you could afford has been cut in half just because of rate increases. We haven't seen a huge impact in the residential housing market. To me, how is that possible? And so I wanted to dig deeper and I need to understand. I want to understand, am I missing something? Is this so different than the past? Or are we just seeing a time delay and a reckoning is coming? No one knows. Like I said, no human really knows. But looking into these data, you can start to maybe see some comparisons to previous years and wonder, okay, what do the trends look like? Or is something going to happen? So, on that note, when I see debt going up by that much and real wages only going up by 8% versus the debt going up by 50%, what's the number one thing that I'd like to look at? Like I talked about, delinquencies in mortgages, delinquencies in student or not student loan. That's important, but that one's been so messed up because of COVID and all the forbearance. So, we're going to set that one aside for just a bit. But credit cards, which are the first you'll let go, and then your auto loans, which I would argue are probably the second to last thing you stop paying. But when you can't, you give up the car and you keep your house. And then, of course, the house being the last thing. So I've got another chart here from the New York Fed Consumer Credit Panel here. I'm going to show it and I'm going to put it up on the screen as we talk about it. And as I said before, if you look at where we are, the last reported reading, Q1 2023, mortgage rates aren't that bad. The transition into delinquency for 30 plus days by loan type. That's what this shows. So this means how many loans out of all the loans that are out by this type, and this is broken down by student loans, auto loans, credit card loans, HELOC loans, so home equity lines of credit, revolving lines of credit, and mortgages, how many of them as a percent of total have gone over 30 days delinquent? And why is that important? Because if you look at the trend and what happened in 2006 and 2007, all leading up to Q3 of 2008, where everything came crashing down, you saw a very negative trend in these rates, certainly in the mortgage rates, but in the auto loan rates, in the credit card uh, defaults. And so, if we're trying to anticipate, or if I'm wondering, okay, things have gotten a lot more expensive, we're not seeing any issues in the housing market in terms of default. But what about credit cards? The things, the first thing that you're going to see go. We already said that total debt per household, we divide it by age group, but just total debt is higher than it's ever been historically. Let's look at the default rates on first your credit card and then your auto loans. So, looking at Q1 of 2023, mortgage defaults, or excuse me, mortgages that have gone over 30 days delinquent, are at 2.43%. If you look on the chart that we're looking at, that's the yellow line. That's really not that bad, historically speaking, especially compared to the 2009 2010 timeframe. So that's positive. Now, I will note it is a little bit concerning if you look at this chart that the trend seems to be going up. Now, doesn't seem to be going up at an alarming rate, but it looks like it had bottomed out, at least in the last 4 years, around the middle of 2021. And we see a trend, an upward trend of mortgages that are getting 30 days delinquent, but still nothing, in my opinion, and historically speaking, too alarming, 2.43%. But what about credit card loans and auto loans? What are those showing? And if you look at this chart, you can see that credit card loans are 6.51% right now as of Q1 of 2023. Uh, and auto loans are at 6.88%. Now, that in and of itself, without context, means nothing. If we look at when those delinquency rates topped off after the 2008 Great Financial Crisis, credit card debt topped off at 13.78% in Q4 of 2009. and auto loans topped off at 10.85% in Q2 of 2009. So a lot of these, if you look at mortgages, that topped off at 12.44%. Now, bear with me. I know this is a lot of numbers, but this is important, and we're going to get to the final point. So we're nowhere near those numbers. Auto loans at 6.88% of total loans that have only 6.88% are 30 days, past 30 days delinquent, have moved into the 30 days delinquency. Credit cards at 6.51%. So that's a lot lower than the absolute top during the great financial crisis. But how has it been historically? That still seems to be relatively low historically, but my concern here is the trend. There seems to be a steep positive upward trend in both auto loan delinquencies moving into 30 days past delinquent and credit card loans delinquent past 30 days. And that's what I'm looking out for because, as I said, those are going to be the first ones that people stop paying because of the consequences of not paying those. Credit card debt, basically no consequences other than it can destroy your credit report. Vehicles, of course, you don't want to lose your vehicle, but you're certainly going to stop paying that before you would your mortgage. Now, what we throw in here is if you look at this chart and you look at student loan debt going past delinquent, you see a huge drop in 2021. Well, why? Well, that's because the government, because of COVID, basically put everybody's loans on deferment, on forbearance, so they didn't have to pay them. And that has basically remained flat. Well, with this new ruling with the Supreme Court saying this, forgiving this, so you never have to pay it back, being unlawful, those are supposed to start payments are supposed to start back in September, October. Now, I know the administration is working on trying to gradually ease into those payments. I'm not sure where they're going to end up on that. But for me, when I look at the trends in auto and credit card debt, percentage going 30 days more, 30 days delinquent or more, and that steep trend, I'm starting to think, okay, these are numbers we really want to watch. If we want to have a better understanding of what might happen, given the rapid increase in rates, we should be following these numbers on a quarter to quarter basis. And if we continue to see this upward trend, given the debt levels that we know, it could take an auto loan crisis. That's all it could take to start having ripple effects throughout the economy. Will it be as impactful as the mortgage crisis in 2008? Probably not, but who knows? It's hard to say. And these are things that I think that we need to be looking out for because if we don't, we're going to get caught off guard. Tons of people were caught off guard by 2008. And so I'm looking at these numbers on a quarterly basis to try to get some insight into why does this economy not make sense to me? And are there things in the underlying data that we should be looking at, that we should see? If you've seen the movie The Big Short, that talks about a couple of people that were saying these subprime mortgages, what these defaults are, the whole thing is going to blow up. And looking back, everybody's like, why didn't I see that? Well, we're trying to do that now. Say, well, look at these numbers. Why didn't I see this coming? Why do we care as business owners? Because it's important for us, not only personally, because we want to know if the economy is headed into recession, but for business planning purposes. When you're an entrepreneur and you're trying to grow your business and it gets more expensive to do so through lending, that has an impact on your business. When large businesses are making capital decisions in terms of are they going to invest more money into furniture, fixtures, and equipment, they're going to make that decision based on where they see the next couple quarters. And do they think the economy is going to go into a recession? So that overall macroeconomic picture has a huge impact on us as business owners. Inventory levels, as I've said, I have a coffee and bike shop with inventory that we have to think about with my business partner and friend Adam. And a lot of bike shops right now are struggling really badly because during COVID, you couldn't get anything. And when they had the opportunity to load up on inventory, they did. And now they have huge gluts of inventory that they can't get rid of. And that's expensive to hold on to, I think. And we've already seen some bankruptcies in the bicycle industry. And I think we may continue to see more inventory, the retail industry inventory. It's a huge decision that every company has to make every year. How much inventory are you going to buy? And they look at the macroeconomic picture to make some of those decisions, which of course has effects throughout the business. Construction. I've got a construction company with my brother. What are people, housing prices? I'm here in the Phoenix metro area, and housing prices haven't really gone down in certain counties or areas, cities, municipalities. They have, but on balance, when a home got 50% more expensive, or I should say 100% more expensive, meaning the amount of home you can buy has been cut in half over the last 13 months because of rates, you would expect to see a huge impact on housing home prices. But we haven't really seen it. Maybe a small amount, but we haven't seen it. And to me, that doesn't make sense. So, are there other numbers that we can look at that may give us some indication, or at least things we should be monitoring to be cautious and careful about? And I believe what we talked about today, total debt by household versus or total debt, historically highest it's ever been, versus real wage growth, which is down, and that trend has been going down. We've seen an uptick the last couple of quarters, but real wages, the consumer's spending capabilities, I'm concerned the correlation between those two. And then when I start looking and seeing a quick upward trend over the last few quarters in auto defaults and credit card defaults, defining defaults as going 30 days or more delinquent, it's something that I'm being very cautious about and I'm watching. So, where are we in the economy? I think lots of people have a lot of speculation. Nobody knows. I've been concerned that we haven't gotten into a recession, and I'm of the opinion, and again, this is just my opinion, but I'm operating very cautiously in my businesses in terms of making any long-term investments because it doesn't make any sense to me that you can raise rates by 5.25 basis points faster than we ever had in the history and not see in the numbers, not see something give. Economically, it just doesn't make sense. And I am a big believer, and historically this is proven out, economics always wins in the long run. So I talked about timing. In the short run, you can defy economics for a certain period of time, but in the long run, you cannot. What is that time frame? I don't know. But when I start looking into some of these numbers, things that I believe are just common sense numbers, defaults on credit card and auto loans, total debt by household, and I'm seeing some of these trends, it gives me a little bit of pause for concern. What do you think about the economy? Share your thoughts with me because there are so many people, lots of experts out there, people that do this every day, look at numbers for a living. And it's so split that I think that makes it challenging for us as business owners to make decisions when so many people are telling us completely opposite things. But it's important that we do our own data, we use our own common sense, and we say, hey, are there things that we can be looking at? Just the average common individual, average business owner that might give us some insight that maybe isn't being looked at as much or isn't talked about as much that might help us make better decisions and help us to decide whether to make that next employee hire or make that next capital investment, or maybe we should wait until we get a little bit more clarity in some of the data we're looking at. Reach out to me. Follow me on Twitter, follow me on Threads, A Holland Podcast. I'd love to hear what you have to say about this. Ask your family, friends. I'm one of those individuals that enjoys talking about the economy, enjoys talking about the business. I love watching the Fed. I'm excited to see what their decision is this week. I think for those of us who have been in the financial industries before. Maybe we're kind of wonky or this stuff fascinates us. It certainly does me. I don't just do it because I'm a business owner, but I genuinely enjoy learning about these things and trying to better understand them. And for those of you who maybe find it as business owners kind of boring, certainly can understand why you might think that, but I think it's important as a business owner nonetheless to be paying attention. So share your thoughts. Tell me what you think. If you think there's some data I missed or other things we should be looking at, I want to hear that from you. Like I said, this podcast I started to be an ultimate support group for all of those of us who are aspiring to be business owners, are currently business owners, and even on the most volatile or lonely of days, or when we have wins, we want to share it with people. That's what this podcast is for. So please reach out, share it with me. Go to our website, theandrewhollandpodcast.com. You can email me there. As I said, Twitter and Threads. You can always tweet at me and we can have those conversations. And then lastly, join us on our YouTube channel, The Andrew Holland Podcast. I released a video version, and that's going to be particularly important for this week's podcast because you'll see those charts and it'll help you follow along. And I think this is going to be interesting for all of us to continue to follow and watch some of these numbers we talked about. That's all the time that we have for this week's episode of the Andrew Holland Podcast. Thank you so much for joining us. Have a great rest of your week, and we'll talk again next Wednesday. Thank you for listening to the Andrew Holland Podcast. Be sure to visit our website, theandrewhollandpodcast.com, for additional content on business, entrepreneurship, and everything in between. Subscribe to our YouTube channel, The Andrew Holland Podcast, to get notifications when new podcasts have been released. And lastly, follow us on Twitter, A Holland Podcast. That's A Holland Podcast, for all the conversations we're having outside the podcast. Thanks again so much for joining us this week. Have a great day, and we'll talk again next week.